All right, folks, here we are on Trading Nut. We've got James Eaton here on the show. Now, he's all the way over there in Spain. If you do want to hear his full podcast, which was freaking awesome, head over to the link below. Go and check it out after you watch this, where he's going to walk through some structures that you can pretty much apply to any trading strategy. So, James, welcome to the channel.
Thank you very much. Thanks again for letting me come on.
Let's share your screen and check out what you got to show for the guys. Hey folks, my sponsors City Traders Imperium have just launched some amazing changes to their funded trader program you got to check out. You can now skip the whole evaluation, trade gold as well as Forex, plus they've increased the drawdown you're allowed in both the evaluation and when funded. With C2A, it's even faster and easier to reach up to $4 million in funding with a 50 to 70% profit share. Click the link in the description to find out what else has changed.
Yeah, obviously I talked about the concept when I was in that testing phase. I was looking at all those different technical patterns, the wedges, the pennants, the triangles, all of that. And I touched on how ultimately, depending on the exact size and variation of these structures, they all fall into what I found is that they fall into one of 5 different categories. And that's what I want to walk through, because depending on, regardless of what trader you are, regardless of what you're using, if you can learn how to understand and interpret these price structures, certainly from a higher time frame perspective, they're going to hold a lot of utility, a lot of weight in being able to actually then effectively predicate direction, predicate momentum and trend, and then find lower time frame entries into those movements, if that makes sense. So the first one, the market we know moves impulsively and correctively, right? Like just by default, it's got to be moving in one of those fashions. It's either moving impulsively with clear directional momentum and trend behind it, or it's not, right? So when the market's moving impulsively, there's 2 ways it can move, right? It can either move impulsively up or impulsively down. It can't be a sideways impulse, right? Just by definition.
Yeah.
So we have 2 forms of impulse. We obviously have an impulsive movement down, and then we get these small corrections, and then we get obviously a completion of that impulse. All right, so that's structure 1. Okay, so you can think we've got 2 impulses and then 3 forms of correction. All right, so this is number 1, downwards impulse. Right, the alternative is, of course, the second, which is obviously an upwards impulse movement to the upside. We obviously get correction, and then we get continuation and completion. Okay, so we get number 2. All right, so 2 forms of impulse. Right, it's that simple. Now, these are relative to the time frame that you're looking at. Okay, so you can spot these on the 1 minute chart, you can spot them on 4-hour, daily, monthly, whatever. Okay, and of course the market's a fractal, because what we can find is that there's going to be multiple different structures, within one impulsive leg of the higher time frame. All right, and that's where multiple time frame analysis, and again coming back to the podcast, why that is so important. Now, when it then comes to corrections, okay, so we have 2 forms of impulse. We then have 3 forms of corrections. The market can be moving correctively upwards or ascending. It can be moving correctively downwards or descending, or it can be moving correctively sideways, what we call like a range. So again, what we can do is we can then say that a correction is any form of price movement that isn't an impulse. All right, if it's not an impulse, by default, by definition, it's going to be a correction. Okay, so that's the first of the corrections, which is ascending. So that's our third thing. The alternatives, of course, are downwards. These aren't drawn perfectly as well. Okay, remember these can differ in shape and size and variation, and whatnot. But these are effectively just the sort of basic principles. So that's number 4, and then obviously the 5th and final is a sideways correction. And again, this is of course relative to the time frame, where price is just range bound, trading between 2 sort of thresholds, if you like, sort of support and resistance from a classical sort of perspective. All right, so we have upwards impulse, downwards impulse, ascending correction, descending correction, and sideways correction. Now, it is a slightly oversimplified sort of classification system, if you like. But if you go onto a price chart, doesn't matter what time frame, 15-minute chart of Bitcoin, 1-minute chart of gold, it doesn't matter, whatever, you will find that every form of price movement will have to fit into one of these movements. Okay, sometimes it does take some time to spot, but by definition, it's going to fall into one of these movements. So you can immediately classify every form of price movement into one of these 5 structures.
Hey, want to trade crypto and gold like the institutions? Well, you can, and it's free for 14 days with Sage Strategies, fully automated trading strategies. Check out their live track records for 25 unique strategies, plus they host everything for you, which is perfect for beginners to advanced traders or investors. Simply sign up for their 14-day free trial today to experience it for yourself.
Now, the trick is then actually understanding the logical sort of expected progression and price movement which arises out of these structures. So even though you may not necessarily trade the ascending channel, you can use it to predicate the likely direction that's that's going to arise out of it. So even if you trade moving average crossovers on the lower time frame, you can use these from a high time frame perspective to actually predicate and anticipate the likely movement that the market's going to give us. So I've got a little example of Bitcoin. We again talked about this in the podcast. I'm just going to remove these just to clean it up a little bit. And look, I'm not going to go into the exact specific lower time frame entries that we use to actually capitalize on these movements. Again, I want to make that distinction that these aren't necessarily what we use to trade. These are what we use to predicate direction from the high time frame perspective. We then use our lower time frame entries, whichever that is, whether it's a moving average crossover, again, whatever that is, you can use these to obviously help find that likely movement that we're going to see. So Bitcoin, we can see here we have a very clear, very objective upwards impulse. And again, look, this is where it gets confusing, because if you now study this leg on a lower time frame to it, if you go down onto this leg and look at this on the 1 hour perspective, you're going to see those 5 price structures within that one impulsive leg. And this is, again, why I say that multiple time frame analysis is so, so important. But from this perspective, just looking at this from a simple perspective, we have the upwards impulse, and then we get this here. Now, this particular price structure, I'm not going to go into depth into each one of the 5 structures, but this is, of course, the ascending channel. Okay, so the ascending correction. And we know that this is a reversal pattern, because when we look at it from a simple perspective, the market makes a high here, right? I'm going to take price back to this point here. The market makes a high. It breaks that high at this second point here, and then it pulls back underneath that level. Okay, so it's made a high, and then it's failed to sustain that price point. Okay, so this is now effectively our second high point. And once we've had that second failure, that second rejection high failure, that gives us the basis in which to actually draw our trend line. Now, at this point, it's just a guess, right? Obviously, it's not confirmed until we get that least, third sort of rejection of it. It's just an assumption, right? It's just a thesis. So the market's now made a second high, and it breaks above it again for that third time. And then again, it pulls back underneath that level. Okay, so it's broken its high. It's then failed, pulled back underneath that level. So now we've got 2 times the market has tried to make a new high and ultimately failed, right? It's broken above it, pulled back, broke above it, pulled back. It's failing to sustain those new higher prices, right? So once that buying pressure dries up, in the case of this channel, the only thing that's going to be left is sellers, right? So we're expecting a then impulsive movement, a downwards impulse movement, again, coming back to those 5 structures out of this. Now, in the case of Bitcoin, we get that perfectly. We get the downwards impulse, we then get the small correction, again coming back to the 5 structures, and then we get a continuation in the form of another impulsive movement to the downside. Okay, so we can use these structures, and these play out. I mean, you can go back, I can find dozens of examples of where these, of how these structures hold utility. But you can see the same principles occurring literally time and time again over any time frame. Okay, now I want to make it clear that we're not using these to actually trade per se. We're using these to forecast likely higher time frame directional momentum and trend. Okay, it's then up to you to obviously find and experiment with different time frames to actually find defined entry points into those movements. Okay, so that's obviously the distinction. But as I said, 5 price structures, 2 impulses, impulsively upwards, impulsively downwards, and then 3 forms of correction, correctively upwards, correctively downwards, and then obviously a sideways correction. 5 price structures, go back onto the time frames, start off with the daily chart, find these, mark them off. You will find them repeating themselves over and over and over again. And I always say, to my members, once you start spotting these, you cannot unsee it. All right, you will just always be looking through the market through this lens of like, right, that's an upwards. And then as I said, once you understand the natural, logical kind of movements which arise out of them, you will be able to predict to a very high level. And then all it's up to you is to find a strategy which actually turns those into profitable trades on the lower time frame.
Hey guys, ever wonder what broker I use? Well, I use these guys, Hanko Trade. Look, it was a no-brainer for me because I was looking for a broker with really good trading conditions and one without any leverage restrictions. Look, also, by joining Hanko Trade, I was able to cut my cost of trading significantly with their super low commission of $1 per 100K. Look, if you want to find out more, check out hankotrade.com or there is a link in the description. And guys, if you want to go and find out how much back testing James actually did, then go and check out that podcast. Link below the video. James, thanks for sharing with us there today. It's been awesome having you on the show. What's the best way for the guys to get hold of you?
So you can go to my website, which is tradingjam.co.uk. Equally, you can go to my Instagram, which is James Eaton. That's James and then EATON FX. And that will, you can then follow me on Instagram and contact me there.
Cool. Awesome. Right. Well, look, James, thank you for coming on the show, guys. Yeah, as I mentioned, there is a podcast link below the video, and all those links James has mentioned are within that link. So if you want to find him, then head over there. Do remember, hit subscribe, hit like, click on the notifications bell, click all, and get notified when future videos like this go live. See you in the next one.